Hey, I'm Ali from FX ORDERFLOW channel, and in this video I'm going to explain why you are keep losing in the market. It only has two reasons. The first one is that you don't have an edge in the market, and the second one is psychology. The first one is much more important than the psychology. Yes, it's much more important, and you might not agree with me, but without an edge, you cannot possibly have psychology in the market. And it's like building a house without a foundation, which is impossible. We're going to talk more about that later in this video. So let's talk about edge. Trading is like a war, and in this war you are a general, and your soldiers are each and every single dollar that you have in your account. Every single one of them are your soldiers. So as a general, you have two duties. The first one is that make sure your soldiers have the best equipments out there. And the second one is your war plan or strategy. Now, obviously, equipments are really important. The obvious example for that is Israel and Iran war, which US just bombed nuclear facilities in Iran like it was nothing, because they had really advanced warfare that Iran didn't. So having the best equipment is really important in trading. So what exactly I'm talking when I'm saying having the best equipment, what exactly I'm talking about? So let's talk more about it. So most of the traders out there, they use level 1 data and they trade on CFD. The only things that they get is open, close, high, and low. That's pretty much it. So everything that you can get on level 1 data is that. You can just watch the candles and the price just moving to one direction, and that's it. And more than 90% of level 1 data users, they lose money in this market. But we have something better, level 2 data. Let me talk more about it because most of you probably don't have any information about it. So you have access to a couple of things here. One of them is time and sales list. So in this one, you can see every single order that getting executed, whether it is buy or sells in the market at the real and live time. So for example, this 14 lot here, somebody bought 14 lots in futures market at this price and at exactly this moment. So this is one of the things that you have access to that. This is 1 minute chart, and every candle that you can see here is 1 minute. And you're probably wondering, what are these numbers? These numbers are the volumes that are getting executed in this 1 minute candle at this exact tick of price. And it's the sum of sales and buys. So they add up together in this candle. So for example, on this exact tick price, which is 6197.75 in S&P 500, we have 224 lots executed here, which is the sum of buys and sells. So what can we understand from these numbers and how exactly they are useful? So if these numbers exceed a special number, so they should either be equal to that number or higher, there is a high chance that you are watching the footprint of institutional traders or institutions or orders or hedge fund orders or even big banks. There's a high chance, and if that number is way bigger than the specific number that I told you, which is different on every chart, the chances are even higher for that. So let me have a quick explanation about it. This video is not educational, so I'm not going to go in details. If I want to go in details, this video would be way more than 10 hours. So I don't want this video to be longer because this is not educational. So on this candle, we had a really huge amount of buys here. And these highlighted numbers, as you can see, are the numbers that I talked to you about. Obviously, in this candle, algorithms were activated, and there's a almost 100% chance that some institutional orders were being filled here. So we had so much buys, and even though we had so much buys, the market got rejected and closed below these special volumes here. We had almost 6,500 buys and almost 5,000 sells. So we got rejected and closed down here. So there's a high chance that the market will drop at least for a few pips. If you see that, it doesn't mean that the market will drop 100 pips or even more, okay? It just shows you that it will drop at least a few pips. There are some ways to understand, to just know, to know is not the right word here, to guess that the market will drop way more than a few pips, but I'm not going to talk about it in this video, as I said, because it's not educational. Okay, let's go back to what we were talking about. So in this candle, we also have unfinished auction. When an unfinished auction happens on a bullish candle, it means that we are likely to have a new high. It doesn't matter how much higher it will go. It can be just one tick. We will have a new high, and then market will either go higher or drop. Okay, so we have unfinished auction here. So we're going to wait for this candle. There's a high chance that we're going to have a new high. It's not like a 100% thing. So obviously we had a new high, and then as you can see, sellers were entering the market. Almost each candle here have a negative delta. It means that it has more sells than buys. So we dropped till here. Here we had absorption of sellers. Here we had absorption of buyers. It means that a passive seller was keep planting sell limits with a really high speed that was blocking buy orders that I talked to you about here, and exactly the opposite is happening here. So even if you would enter here on the retest for sells, this is your exit point. So it was a nice and clean scalp trade here, and this is just one example and a tiny fraction of information that you can get from level 2 data. The next tool that I want to talk to you about is like the other one, but in this one, these are 1 minute candles for S&P 500. But in this one, the sells and buys are separated. The left side is for sells and the right side is for buys. So basically it's the same thing, but it's separated. So for example, you know that in this tick, you had 229 sells and 686 buys. So basically the same thing, but it's separated. I don't want to explain more about it because, as I said, it's not an educational video. So this one is called volume profile. You probably don't know anything about it, and if it's the first time you see a volume profile, we also have VWAP. If it's the first time that you're watching a volume profile, it's probably really confusing for you. But let me just do a few examples for that. So this is point of control for the previous week. It means that in this tick of price, we had the most volumes executed here. And this is value area. So this is a really important area for me. And if the market comes here, I expect it to reject from this area. As you can see, we're really rejected here. If you want to do more examples, for example, here, this is the value area for a previous day, and the green line is for VWAP. So once the market came here, we did reject again. Another example is value area high here and also VWAP. We test this area 2 times, and each time we reject. So these are some short examples that shows you how useful is level 2 data. So as you saw in the video, if you're using level 2 data, you will receive much more information comparing to level 1, and you also have much bigger advantage comparing to traders who use only level 1 data. So basically, these are the best tools that you can get out there as a retail trader. So that's why I highly advise you to use level 2 data for trading, because basically, as I said, this is the best thing that you can get for your soldiers. So the second one was a strategy, and obviously this one doesn't need much explanation. If you're using level 2 data, your strategy will be much stronger than just watching a candles or drawing imaginary lines like trend line and just expect the market to respect that every time or most of the times. This is not going to happen. You have to be honest with you, and you need to be smart about it. There is a reason that like more than 90% of traders are losing money. So yeah, this was everything about the edge, and let's talk about psychology. So when it comes to psychology, most traders have like two big problems that is really common between traders. The first one is over-risking. So when it comes to over-risking, usually the common problem is that you don't have enough capital for the money that you want to make. What I mean is that you can't expect a $10,000 account to make money like a $100,000 account. You have to face the reality. If you risk like a $100,000 account, your drawdown also be like a 100K account. So if you're using a 100K account, it's not that hard and impossible to get 10% drawdown. So if you risk like a 100K account on a $10,000 account, there is a high chance that you lose all of your money. So you have to be realistic first. You can't just come to the market with a $5,000 account and expect to make like $2,000 or $1,000 each and every single month. It's impossible. You have to face a reality. So the step one for not risking a lot is to accept that you will only make money based on your balance. If your balance is not big, you're not going to make big monies. It's like every other businesses out there. Without enough money, you cannot make the money that is in your mind. So if you want to trade, before you start to trading, just accept that you can't get rich with a $10,000 account. A $10,000 account ideally will make you, in average, I'm not talking about every single month, it's average. Basically, your yearly income on that account, that is going to be divided by 12, which is 12 months. That's average income for your account. Your average would be something close to $400. If you're risking like 1%, that's the amount of money that you're gonna make on average. Obviously, not every month is gonna be profitable, and not every month you're gonna make 10% or 8%. Some months you might even make less than 2%. So you have to face the reality. If you can't, you will definitely over risk your account. So yeah, this is the first one. The second problem is overtrading. So for overtrading, most traders, the common problem between most traders is that they don't risk a lot, but they do overtrade. Why? You might expect that this month you'll make like $800, right? And if you be realistic, with a strategy with win rate of 50 to 60% and the risk reward ratio of 2, you will get like 15 to 20 trades at most, good trades. that is like reasonable enough to risk money on it in a month. And if you risk like 1% on a $10,000 account, which is like $100, you will get $200 for winning trades and you will lose $100 on losing trades. So let's say this month you took like 15 trades and 8 of them were winning trades, 6 of them were losing trades, and you had 1 break-even trade. So you made $1,600 and you lost $600 and you made $1,000. This is obviously a good month, but you will have bad months also. You will have months like that. So it's been like 25 days and you only made 10 trades. And out of these 10 trades, you had 3 break-evens. You had 4 losing trades and you had 3 winning trades. So in this scenario, you made $600 and you lost, I don't remember if I said 4 winning and losing trades. If it was 4, you lost $400. So basically you only made $200 and you don't want to risk a lot. So what happens here is that you will keep trading and you will take bad trades that you know deep down inside that it's not a good trade. And what happens next is that you find yourself taking 20 trades in one day, 50 trades in a month, which you shouldn't have taken that in the first place. And the reason is that you don't accept that you will have bad months. You don't accept that you only have a $10,000 account. So if you're up like $200 and you have 5 days left, it's not that bad. At least you're not negative. The problem is that you want to make much more money on this account. So if you accept it at the first place that, okay, if I'm having a $10,000 account, as long as I'm making $400, something between $0 and $400, any number between that, that's good to me for that month. If you accept that, if you truly accept that, there's a high chance that you don't stuck in overtrading and over-risking. There are some other problems like sometimes you want to take a trade, you know it's a good trade, but fear comes to you and you don't execute the trade, and by the time you want to get executed, it's too late. To me, one of the main reasons for this problem is that you don't believe in your strategy. And sometimes, most of the times I believe, the problem is actually your strategy. Deep down inside, you know that just making an imaginary area or imaginary line based on the movement of the price is not that accurate. It's not that reasonable for you to risk your money on that. So you don't believe in your strategy, and you're absolutely right about it. Yeah. So that's pretty much it. If you want to know more about level 2 data and volume trading, make sure to subscribe and watch my videos that I'm going to upload every week.